What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the Stocktrades YouTube channel. In this video, we're going to be going over a very important element for Canadian investors, and that is owning the S&P 500. Now, you might think this is a relatively easy decision, but it is a decision that comes with a lot of different choices for investors. A lot of people get way too overwhelmed when it comes to choosing an S&P 500 ETF, and in this video, I'm going to go over 3 of the core ways you can own the index, and they are very, very different. So with that said, let's jump right into the video. Again, everybody, head down below, like the video, subscribe to the channel, join the No BS newsletter below. You're going to get information on the brand new ETF platform we're launching. You're going to get a crazy deal on launch if you're part of the newsletter. Plus, we send 2 times a week newsletters to over 25,000 Canadians covering stocks, ETFs, market commentary, anything you can think of. That link is in the description. So the S&P 500, it's arguable that every single investor should have some sort of exposure to the S&P 500. It is the premier index on the globe, I would say. It tracks the 500 largest companies in the United States. And in the US, it's fairly simple to own this index. You buy it in US dollars. That's your home currency. There's not really that much complications to it, but because this is a US-based index, Canadian investors have a few choices they have to make when buying the S&P 500. And in this video, I'm going to go over 3 ETFs that give you a different choice when it comes to owning the index. Now, the first ETF I'm going to go over is VFV. This is arguably the most popular S&P 500 ETF in the country, but it might not be optimal for most people. Now, I'm going to explain that over the duration of this video, and by the end of it, you're going to have a much better perspective as to what fund you should own, and ultimately, you can make your own decision from there. VFV is a S&P 500 ETF that trades in Canadian dollars. When we look to the top holdings of this fund, it simply contains VOO. Now, what is VOO? Well, that is the S&P 500 ETF in the United States, Vanguard's ETF, and that trades in US dollars. Now, why do the vast majority of investors own VFV? Well, they own it because it is in Canadian dollars. They're comfortable working with their own currency. They don't want to pay hefty currency exchange fees, and they simply buy VFV because it trades in Canadian and it's just overall easier to own. Now, here is some very key elements on VFV. For one, it is not currency hedged. So not only are you exposed to the S&P 500, but you're also exposed to fluctuations in the dollar. If you want to own a hedged ETF, you actually need to look at something like VSP from Vanguard, same fund. So VSP is the currency hedged version, and what you're going to get when you own something like VSP is just exposure to the companies within it. You don't have exposure to the US dollar. When you buy VFV, you are not only exposed to the S&P 500, but in a way you are also exposed to fluctuating currency amounts between the Canadian and the US dollar. Now, you will pay extra fees when it comes to hedging, but the reality of it is there's an added element of risk when it comes to non-currency hedge funds and hedge funds. Now, a very broad explanation that I like to use, and this is something you definitely need to take your own situation into account for, is generally the longer the time horizon you have as an investor, there is a less of an incentive to hedge. Why is this? Well, currency fluctuations tend to level out over the long term. And if we end up paying expensive hedging fees on particular funds, and say 10 years down the line, the dollar is at the exact same amount, you will have paid those hedging fees to protect yourself from currency fluctuations without there even being any currency fluctuations. So ultimately, it's just kind of a fee drag. Whereas if your time horizon is shorter, you live off the cash flows in terms of Canadian dollars, your retirement portfolio and cash flows overall might see a big hit. Say if there was a 10% swing in the value of the Canadian dollar relative to the US dollar, obviously this can work out in your benefit or your detriment. That might be a bit more incentive for one to hedge. But for right now, getting back on topic of the video, VFV is unhedged. So you own the US dollar, the fluctuation fluctuations in terms of that currency relative to the Canadian dollar, plus you own the S&P 500. Now let's go over the second possible fund you could own. You could own something like VOO. This is a US dollar traded ETF. It has over $1 trillion in assets under management. It is one of the biggest ETFs you can get, and it is one of the absolute rock bottom fee ETFs you can also get. We can see it's at 0.03. So for every $1,000 you invest in this fund annually, you're only going to pay 30 cents. This is about as low as it goes. But for many Canadians, they find it difficult to convert their Canadian currency to US dollars, and they ultimately opt for Canadian versions. Now, whether that be again because they want the cash flows in their portfolio to be in Canadian dollars, or they simply don't want to pay the currency conversion fees at a platform like, let's say, Wealthsimple Trade, they choose to own the Canadian ETF over the US ETF. However, you will save on fees inside of this fund relative to VFV. We can see that VOO is 0.03 and VFV is 0.09. So VFV has tripled the fees. I mean 0.6, you're talking 60 cents per $1,000 invested every year difference, but ultimately fees do add up over time. There's another very important element as to the benefits of owning VOO over VFV. A lot of people make the assumption, and it's just kind of a broad assumption because of the tax treaty between the United States and Canada, that if you own an S&P 500 ETF inside of an RRSP, it is exempt from the withholding tax. This is not true in the case of VFV and VOO. If you own VOO inside of an RRSP, you will avoid that withholding tax on the portion of the distribution. If you own VFV, you will not. You will still pay withholding tax in an RRSP on this fund on a particular portion of the distribution. Now, the distribution is relatively small. We can see it yields only around 1.06%, but this is yet another drag when it comes to overall returns. Now, why is this the case? And this is a very common overlook when it comes to taxes of these funds and how the actual treaty works between Canada and the United States. If you have a Canadian domiciled fund like VFV and it holds US ETFs or US stocks directly, so you have a Canadian listed fund that holds US listed ETFs or stocks, that does not qualify for the withholding tax exemption. Why? Well, because it is technically the institution, Vanguard in this case, that owns those stocks or owns those ETFs. And in that situation, they do not give them the tax exemption. So if you own VFV, you will pay more fees and you will also pay a withholding tax on the distribution, even inside of an RRSP. That is a very key element that a lot of investors don't understand. Now, which ETF out of these three, and we're going to talk about a fourth in just a bit, but which of these ETFs, VFV, VSP, and VOO, is best to own? That completely depends on your own individual situation. I'm not going to go too in-depth in terms of VOO in terms of foreign property, but it's also important that a US domiciled ETF like this does count towards foreign property. So it's important to look at that from your own personal perspective and see if that impacts you. But outside of that, it is entirely dependent on your situation. Because I have a long time horizon, because I know that those currency fluctuations are likely, not guaranteed, but they're likely to level out over the long term. If I were to own an S&P 500 ETF, I would probably own VOO. I don't mind owning the US dollar. I like the fact I save on fees, and I like the fact I can stash this away in a RRSP and not have to pay that withholding tax. However, if I want to keep the currency in Canadian dollars, maybe I'm routinely selling shares close to retirement or actually whenever I need cash flow, and I don't want to be converting those currencies back and forth consistently, VFV makes perfect sense. It's just also important to understand that you not only own the S&P 500 with this ETF, you own the US dollar. So you're going to see fluctuations in terms of currency movements with VFV. Now, VSP is something you could own if you want to keep your currency in Canadian dollars, but you also want to hedge against fluctuating currency prices. You don't want a drastic change in the value of the Canadian and US dollar to hit your cash flows or hit your overall portfolio. In this case, VSP is definitely one you want to look over. It's hard for me to determine what is the best ETF for anybody. especially because I get this question, I mean, at least 2 or 3 times a week from people emailing me and asking, which one they should own. I can't answer that, but I can at least, display a little bit of the differences between the three, because there is some differences, and, it's important to understand that everybody's situation varies, and ultimately you just need to make the decision that suits your portfolio best. But the next ETF I'm going to go over is quite possibly, I had mentioned that out of these three, I would own VOO. But to be honest, if I were to buy one S&P 500 ETF in Canada, it would probably be HXS, which is Global X. You probably heard of them before as Horizons. They've transitioned to Global X, and they take a very unique approach to the S&P 500, and they do so by utilizing swap contracts that emulate the total returns of an index. So I've gone over this ETF in depth, and I'm going to leave a link at the top of the description where you can go and look at HXS in depth. I explain how they work. I'll just go over it very briefly here, but what this fund is essentially doing is entering into an agreement with a major financial institution. That institution agrees to pay them the underlying returns of that index plus dividends, and in return, Horizons will pay a fee to that institution. So let's say, for example, if the S&P 500 1-year returns 9% and pays a 1% dividend, the institution that is in the swap contract with Global X will return that 9% total return and that 1% distribution, and it simply goes into the net asset value of the fund. Now, what exactly does this do? Well, in a way, it's a tax deferral, but it's also a situation where many investors might benefit from a more tax-friendly form of income, that being capital gains versus distributions. If we own something like VFV here, this 1.06% dividend yield, this distribution, if it's in a taxable account, it is taxable in the year in which it's received. So you'll get this, you'll get a tax slip, you'll have to pay tax on that distribution. If we own HXS, because the distribution is placed into the net asset value of the fund, the net asset value of the fund will grow with no underlying distribution paid to investors. So let's take the most basic example. Let's say in a taxable account, you own HXS and you own VFV. At the end of the year, you will have the same returns with HXS as you would VFV. However, VFV, this 1.06% distribution will be taxable in that year you received it. Whereas with HXS, you will only be taxed on this fund when you choose to sell it. Now, this creates an element of HXS being sold as capital gains, which 50% of them are taxable at your nominal rate, unless you get into a big situation with holding more than 250,000 of it. Now, with HXS, you will not be taxed on this fund until you sell it. And in that situation, you will actually benefit from a capital gain over a distribution, and in a capital gain, 50% of that is taxable. So it's often the more tax-friendly form of income. So in terms of tax-efficient ETFs, HXS is probably one of the best. It's been around for quite some time. Now again, HXS is not currency hedged, so you're going to get those fluctuations as well, and they also do have a US dollar version trading under HXS.U.TO. But overall, as we can see here, with 3.5 billion in assets under management, whereas something like VSP is 3.2 billion, which, considering it's a hedged fund, the vast majority of investors own unhedged funds. I mean, we can see with VFV, it has 14 billion in assets under management. The hedged fund of Vanguard's S&P 500 ETF actually almost has the same assets under management as HXS, which is pretty surprising because from a tax perspective, this is usually going to be the most efficient option for most people. Again, I'm not speaking on anyone's individual tax situation. Yours could be completely different. And overall, in a tax sheltered account, I mean, you're talking 0.11 in fees. The fees are a little bit higher on HXS rather than something like VOO or VFV. However, in a taxable account, they're very tax friendly, and they do result in a deferral of taxation into future years when you decide to sell as a capital gain. Now, HXS is not without risk. It does have over and above risk relative to something like VFV, VSP, or VOO. Now, why is that? Well, it has an element of counterparty risk. So there's that major institution that is paying Horizons the returns of the S&P 500 plus its dividends to give it a total return for that particular year, let's say, on the S&P 500. When you add this let's say, middleman in regards to being paid something, there's always that added element of risk. Something like VFV or VOO will just simply hold the underlying holdings of the index. Their capital is invested right into these corporations, and as a result, they will benefit from the price increases or the price decreases of those overall companies. With something like HXS, you're depending on a third-party financial institution to make those payments to you. If that institution gets into trouble financially, if they go bankrupt or anything like that, it is possible that HXS maybe can't get those payments, which, I wouldn't say this is that big of a risk at all. But what I can say is that the risk is not zero. Global X deals with some massive institutions with huge assets under management. It is highly unlikely that any of the institutions in this type of situation get into financial trouble, but you cannot rule the possibility out. And that might be why this fund is a little smaller. Maybe some people don't understand the swap contract nature of it, so they choose to own something else. Overall, if I were to buy out of all four of these, I would probably personally choose HXS. It's a great fund. I know people like that passive income stream, that, dividend feeling of getting paid, when ultimately the dividend comes out of the net asset value of the fund anyway. It's the exact same thing as HXS's net asset value increasing over and above what VSPs would at the end of the year, because ultimately this distribution comes out of the net asset value. It is not free money. It comes from somewhere, and ultimately you're going to see that the fund's performance is relatively identical. I mean, if we go to, let's say, HXS, we'll have to add HXS.U for the US dollar version so we can keep it, relatively currency, same constant currency. And if we add VOO in here, just from a pricing performance right now, you can see that HXS has outperformed VOO by quite a bit. Now, why is this? Well, this is a normal pricing return, so this does not factor in distributions. So why is VOO's overall pricing returns less? Well, because HXS gets those capital returns and those dividends into the net asset value of the fund, and it's going to grow more. Whereas something like VOO, that distribution depletes the net asset value of the fund and is reduced. Now, when we go to total return, you're going to see a much different story. You're going to see that the performances are relatively the same. You're talking over the last 10 years around, maybe 0.5% annualized return difference. You're talking maybe 0.3% annualized difference over the years. In terms of, depending on your specific tax situation, this could actually, HXX could end up being a net benefit to you. It all depends, again, on your individual tax situation, but this is a very tax-friendly ETF. The performance of HXS has lagged a bit, probably because of higher fees. You're talking about probably 0.1 or 0.09 of a difference every single year, and over a 10-year time period, that does erode a bit of the returns. But depending on your own individual tax perspective, this could end up being an ultimate benefit, even though there's a bit of a lack of returns there on a constant currency basis. It really all depends on your own situation. So overall, which fund would I own? Well, it's pretty much irrelevant because each one of these funds presents a very unique situation for many Canadians. For VFV, it's unhedged exposure to Canadian dollars. It might be for people who want to draw down on those cash flows. They want to keep their currency in Canadian dollars. Maybe they spend all their money in Canadian dollars, and they don't necessarily feel the need to pay higher hedging fees. They don't mind the exposure to not only the S&P 500, but the US dollar as well. When we look to something like VSP, you're currency hedging yourself. You're mitigating a bit of those currency fluctuations, which, although they do tend to level out over the long term, can be very volatile over the short term. And if you depend on that cash in retirement, if you need those cash flows, you don't want to put them at risk in terms of forex changes. A hedge fund might not be a bad option. For those who want to just simply own the S&P 500 inside of their RSP and mitigate that withholding tax, and maybe they don't mind paying the currency exchange fees at owning the US dollar, VOO is not necessarily a bad option. You will mitigate that withholding tax. You'll save quite a bit it, even though it's, 6 basis points over the course of the year, you will pay 1/3 of the fees as VFV. But in this aspect, again, you have to worry about foreign property ownership, which ultimately I can't speak on that whatsoever. That's all up to you. But overall, VOO is a solid option in those situations. And from a tax efficiency perspective, HXS, its total return methodology via those swap contracts is a very good option for those who might own this in a taxable account. Not only will you avoid the withholding tax because it's a swap contract and they're paid a set return rather than a total return and a distribution, you're going to save that. You're going to defer taxes to the point where you'll only be taxed when you sell units. And ultimately, you're going to get not in all situations, but in a lot of situations, a more tax-friendly form of income in the form of capital gains versus dividends or an ETF distribution. So everybody, I hope that at least helped you make the decision in terms of S&P 500 ETFs. It's a great index to own. It's been a strong performer for quite some time, and a lot of Canadians want exposure to it. They just don't know how. So again, if you like the video, smash that like button, head down below, subscribe to the channel, join the No BS newsletter, free stock picks, ETF picks, market commentary, case studies. We're doing everything like that twice a week to newsletter members. You can head down to the description below, click the link, join it. It's absolutely free, and we'll see you next time for more great Canadian content.